Dividends are the best way to grow your wealth and make sure that you're living a financially free life without being chained to a 9 to 5. It used to be crazy to me that more people don't know about dividends or don't invest in them despite how life-changing they can be. But now I understand that there isn't enough high-quality information out there teaching people how to actually invest in dividends.
So I'm making this video to help you understand how to build a safe, high-yield monster dividend portfolio step by step, so you can be armed with the knowledge and confidence that you need to take the first step in completely changing your life with dividends. I'll be going through what dividends are, selecting the best dividends, diversification, and some other tips from me that I've learned through my own mistakes, which you won't hear anywhere else. So you'll definitely want to stick around for that. Let's start with, what are dividends? In simple terms, when you invest in a company's stock and become a shareholder, you're in for a treat called dividends. It's essentially a company sharing its profits with you. If the company makes money, it might decide to give a portion of it to shareholders like you. The amount is usually a percentage of the stock's price, called the dividend yield. This helps you know how much you might get in return. Now, some companies are like clockwork, handing out dividends regularly every few months or once a year. Others might surprise you with special dividends when they're swimming in extra profits. Let's use an example. Say you own 100 shares of a company and they pay you 50 cents for each share every 3 months. That's $50 coming your way every 3 months. If you use that money to buy more shares, your investment can grow over time. It's like a snowball effect. More on that later. But why do people love dividends? Well, there are a couple of reasons. First, they give investors a steady income, like a paycheck. Second, stocks that pay dividends are often from stable and profitable companies. So even if stock prices play the roller coaster game, these companies usually stay strong. At this point, you're probably wondering, how do I select dividend stocks? Remember your mom's advice? Safety first. The same applies when you're selecting dividend stocks to invest in. The easiest way to dodge risks in investing is before you even start. Set your criteria, do your homework on potential companies, and wait for that perfect moment to take the jump. When in doubt, wait some more. Saying no can save you a lot of trouble in the investment world. So what's the golden rule? Look for nice blue chips with rock-solid balance sheets, yielding 4 to 5% or even more. It's not about avoiding all risks. Some are inevitable, but you can definitely dodge the unnecessary ones by picking your investments wisely. Here are 2 examples of dividend stocks I've invested in and why. The first is International Business Machines Corporation. It's been paying dividends for a whopping 28 years straight. Through thick and thin, IBM has consistently increased its dividend payout. Even in 2023, they raised it again, showing they've got the cash to keep the streak alive. This makes IBM stand out as one of the best dividend stocks. Now, if you're eyeing IBM, focus on its potential for future dividend growth. Since 1989, IBM has been increasing its dividends, and it has a promising 10-year dividend growth of around 7%. Another ace in the deck is Microsoft. This tech giant, known as MSFT, has increased its dividend for 11 consecutive years. Sure, the current dividend yield might not seem mind-blowing at 0.8%, but take a step back. Look at the big picture. Microsoft has an impressive 10-year dividend growth rate of around 11.57%. Despite the current lower yield, the consistent dividend growth over the past decade makes it a winner for long-term investors seeking steady income growth. So, don't make decisions based only on current numbers. History shows the potential for rewarding investors in the future. When it comes to picking dividend stocks, you want to keep it simple, keep it safe, and watch your investments grow. Aside from these 2 examples, if you've got a favorite stock or want to have a look at some more, which I would recommend, then you absolutely should check out the Dividend Aristocrats list of the S&P 500 Index. These companies are rock stars, raising their payouts annually for at least 25 consecutive years. They're spread across various sectors, but they all share a commitment to reliable and long-term dividend growth. Now, before you dive into picking stocks, let's look at some mistakes to avoid. First up, find companies with modest payout ratios. This ratio tells you how much of a company's profit is shared as dividends. Aim for 60 or less. It gives you wiggle room in case of unexpected troubles. Anything above 70? Not a good idea. Trust me, I've learned the hard way in my early investing days. Next, look for companies with a history of raising dividends. Take Bank of America, for example. Back in 2011, its quarterly dividend yield was a tiny 0.1%. Fast forward a decade, it was sitting at 2.2% with a 21-cent quarterly dividend in 2021. Small changes can lead to big impacts in the long run. Now, here's a big one. Don't get caught in the high-yield trap. Many investors, including myself back in the day, focus too much on a company's starting yield. High starting yields might look tempting, but they can be a value trap. Companies like Barnes & Noble in the past tempted investors with high dividend yields, around 9%. But they faced financial challenges due to Amazon's competition. While they paid dividends, it was more than what they earned, and sales were dropping over the years. The share price was on a roller coaster, and there was a lawsuit from a former CEO. Eventually, the company was taken private, and so this was definitely an investment to avoid, even though the dividend yield looked so good. Here's the lesson. Don't get lured by high starting yields. Focus on companies that consistently grow their dividends over time for better long-term returns. Once you have a good selection of companies to add to your portfolio, you need to know what to do with your dividends. You should be looking at dividends as a long-term investment, so you really should be reinvesting so that you can take advantage of the snowball effect and multiply your wealth. I've made a detailed video explaining the snowball effect, which I highly recommend you check out on my channel. Now, this is another massive factor to bear in mind when it comes to building your monster dividend portfolio. Diversification. This is a strategy used by seasoned financial experts. Instead of going all in on one option, you spread your investments across various opportunities with the goal of greater returns and reduced risk. Think of it this way. You wouldn't want all your chips in the oil industry, right? If oil prices take a hit, that could spell trouble. So, diversify wisely, covering different industries, and shoot for about 5 to 7 stocks to keep things streamlined and effective. Don't overdo it. When it comes to knowing exactly how much you should invest and how frequently, you need to look at your goals and then reverse engineer. Are you investing for early retirement or with the goal of living off dividends? Once you know your goal, you can work your way backwards to calculate if you should invest $100 every month or $1,000 every 6 months, and so on. I've broken this down further in my video on the fastest way to live off dividends, so definitely check that out. And for more helpful videos like this, please don't forget to like and subscribe to my channel.